Well. For all those would-be home buyers out there, it looks like they're going to get a little break. They've been waiting on that interest rates to drop before they finally jump in the market and think that, it's a good time to buy a house. Well, 2024 could be their year, huh?
Yeah, Christmas came early today.
It did. Old federal chairman Jerome Powell, he's the guy that heads up the Federal Reserve over there. It's supposed to be independent from the government, but somehow it's appointed by the government. So don't ask me how that all works, but he's the main boss here that controls interest rates and so on and so forth. I think what Powell was doing, I didn't think what he was doing, what he was trying to do was get the economy down to the inflationary target of 2%. Uh, Came close, I guess, close enough to where he decided that, you know what, they're going to drop interest rates a little bit in 2024. Didn't say when per se, but he's thinking 0.75%, three quarter of a point.
Yep. Three cuts, so you could figure about a quarter of a point each cut.
That's not a lot.
It's not a lot,
It's not
but it's
quite,
welcome.
it's welcome. It's not quite the 3 to 4% that some people are waiting to see happen again.
Yeah, it's gonna take a while to get back there, and I mean, there's still a lot of things that they got to get in line. I mean, for the most part, what you're seeing is the light at the end of the tunnel. So with that, we do want to give a little toast because we're having tea time tonight.
Yep.
Uh,
Well,
so
tea
so we'll
time.
do a little toast to the Federal Reserve and all their hard work in order to get us to this point.
Mm, that's delicious tea.
Yes. Now they still got a lot of work to do, and it is a tightrope. And I think the reason why they didn't give a timeline for when the cuts were going to go into effect and how that was all going to go is because they still have to make sure that they don't tip the country into a recession.
Yeah, speaking of recession, Powell said Fed doesn't need a recession to cut rates. He said the Federal Reserve is willing to cut rates even if the U.S. economy doesn't dip into a recession in 2024. So he said no matter what. It could just be a sign that the economy is normalizing and doesn't need the tight policy. He also said that the Fed is now seeing progress on inflation across the three main core areas. That the the comments could ease concerns that the projected rate cuts reflect a split opinion on how the economy is going by said the Fed members. Overall, they seem to be in tune with economic realities, which is encouraging as we enter a new chapter of the Fed reaction function, said Dylan Kremer, Chief Investment Officer for Centruity. And this was according to CNBC. All right. So some people were thinking the only way really we are going to see interest rate cuts is if we went into a recession because economy, in order for interest rates to go down, has to slow down. The labor markets and the consumer price index, everything has to slow down because apparently our economy is just red hot and on fire. So that's why they were keeping interest rates up the way they were.
Yeah, and all of it makes sense because earlier we got the GDP report that said, "Hey, we had the greatest economy ever, came in at its highest levels ever."
Mhm.
But today, with the news that comes out that the interest rates are going to start getting cut, and even though they're small cuts, it's very welcome. You've seen that today. The stock market went nuts
Nuts,
after
nuts.
the information came out, just went completely crazy, reached an all-time high. So if you got money in those 401ks or if you're prior military, you got a TSP account, know that those accounts got a little bit healthier today on this good news that came out.
Yeah, Powell said overall the development of the labor market has been very positive. It's been a good time for workers to find jobs and get solid wage increases. You see job growth still strong, but moving back down to more sustainable levels given population growth and labor force participation, he said. Wages are still running higher than what would be consistent with 2% inflation, the Fed's target inflation level, as we said, over a long period of time, but gradually been cooling off, he added. So payrolls grew faster than expected in November, while the unemployment rate fell. Okay. So obviously, he says 0.75. but market speculators are not seeing it that way. Matter of fact, the Federal Reserve on Wednesday indicated it would be cutting its key interest rates by 3/4 in 2024. Markets still think it could be double that. Following the Fed's meeting, traders in the Fed funds futures market were pricing in 150 basis points or 1.5 percentage points worth of cuts in the year ahead, according to CME, Kroup's Fed Watch indicator. That would be the benchmark funds rate down to a target of 3.75% to 4%. But that's not people's mortgage interest rates, are they?
No, it's the Fed's rate, but I think that more so than anything, the reason why the Federal Reserve is saying 0.75 basis points is what the reduction is going to be, and others are speculating higher, but they're speculating higher because normally when you get good news, you get excited and you
Yeah,
think it could do better. But
right.
I still think that there is a lot of work that needs to be done, in particularly in the housing sector. The data that came out on Tuesday said that the inflation rate rose 6.5% in shelter, which is rents and mortgages.
Hmm.
And obviously, the mortgages are higher because the rates are higher, but the rents are higher because there is an inventory problem in this country.
Yeah,
And so, therefore, the rise in shelter costs accounted for 70% of the total rate of the inflation. So the biggest problem that the Federal Reserve has to solve now, or the government has to solve in its totality, is we've been talking about we have a shortage of homes to the tune of 7 million homes we're short in this country.
hmm,
And then we also spoke about how billionaire investors are buying up middle class homes.
yeah. Our last podcast.
Yeah, so it
I'll link it
cre-
at the end of the video, by the way.
yes, and so this creates a further gap in the number of homes that we need in this country. And at the current rate, builders aren't building enough houses, and they're a small, tiny band-aid on the bigger problem here.
Right.
And so until we're able to solve the housing issue in this country, it's going to be a lot more difficult for them to get the rates down at a faster pace. We got to figure out how we can get the cost of shelter down, because once you get food in line, which for the most part it is,
Yeah.
and you get gasoline and energy prices in line for the most part, which
Natural
it is.
gas is in free fall, it
Yeah.
seems.
So once you get all those in line and you have your labor market, which is on pace, the last shoe that needs to drop is the shelter. And this is a big problem that not a lot of people are talking about, but I do believe that the Federal Reserve knows that when they look at the inflation of what's left to get back to 2%, they got to figure out this housing problem.
Yeah, and I think you and I were chatting offline about this. One of the biggest things that builders are facing right now, it's not that they don't want to build, it's just they don't have the skilled labor to keep going.
Absolutely.
Yeah, because you have, I don't know why.
I'll tell you why. Nobody in America says, "Hey, son, hey, daughter, I want you to grow up and be a plumber.
Right.
I want you to grow up and be an electrician or a carpenter or an HVAC technician." Nobody says that to their children. Everybody wants their children to be doctors, lawyers, bankers, whatever. It's something that's a little bit more glamorous, other than, the sports and celebrities and things of that nature. But for the most part in this country, we don't have our parents saying, "Hey, you need to be a laborer and at the finest levels
A
of things."
skilled labor, though.
Eggs,
These guys make bang up money too.
that's what we need, and that's what a lot of people don't understand, and that message is not being conveyed to the next generation, that there is a lot of money being an electrician, that you can command what you want as an electrician. Like, if you're a doctor, you got all these healthcare benefits that you got to go around, and you might charge 5,000, but the insurance company says, "No, I'm only giving you 2,000 for this," and you just had to take a 60% cut in what you were looking to get.
Mhm.
Whereas an electrician, they say, "Hey, it's $5,000 to do the job, it's nothing for me not to do the job. Your
Right.
choice.
Yeah, and then unfortunately, in the housing sector, needing that skilled labor to build more units so we can have more inventory so that it matches buyer demand and prices don't rise as high as they do and maybe even drop a little bit or adjust accordingly. But until that happens, and there's no easy fix for this, this is only going to be time and culture change, which if you're trying to buy a house in 2024, for example, or 2025 or 2026, that's not happening anytime soon. High prices of homes, I think, are here to stay.
Absolutely, they are, and I'm surprised you haven't said it yet because you've been foot stomping on this a lot lately. But that reverse housing market collapse, like that picture, is actually now more reality than anything because, yeah, all these other inflationary issues have been tackled and they've been tamed down pretty good right now, and the Fed's got that under control for the most part.
Right.
But this housing part, the shelter part, this is not tamed and it can't be tamed unless you get more inventory, which that's not an easy problem. So as the rates go down, buyers get back in, home prices go up, you start seeing people priced out of the market, they can't compete again. Not to mention we still got those billionaires that are over here trying to jump in and buy up all the houses in the middle class. So there's a lot of issues that got to be tackled.
Yeah, which by the way, Congress, I think it's in the Senate now, they have a bill trying to keep the Wall Street or these big billionaires out of the single family market so regular people can have a chance at the American dream. I support it and I hope to God it passes. Probably not before the holiday session is over and they go on, vacation and whatnot and come back. But I'd like to, I want to keep tabs on that and hopefully that takes form because I and you and I have always been big advocates of home buyers and homeowners. So
Yeah, home ownership is
yeah,
part of the American dream.
right.
That's what you and I signed up and fought for all the years that we served. But right now it's not looking good. The sight of everything that I'm seeing is not good. And not to mention with all the news that just came out today, those billionaire investors, they had a plan that they were gonna buy 7 million homes over the next 6 years, that was gonna end in 2030. But now with this news that's out, they now know that they need to kick into gear right now and buy up as many single family homes as they can because they know before long that the American people are going to get back in the housing market and start trying to buy houses. So now they're going to be competing again. Now, again, the average American is not able to compete with a
No,
billionaire
no,
investor.
no,
However, any competition for an investor is never good.
no.
Their goal is to buy low always. So they're probably going to ramp up their home buying evolution now in the short term, vice waited out long term. So it wouldn't surprise me to see more homes being bought in the short term before these interest rates get dropped by more investors.
Yeah, if what if what Powell is saying, the 0.75 bips, basis points, and then if Wall Street is correct with their speculators at 101.5% or 150 basis points, that would probably put the average mortgage rate, if it goes down to 150 basis points, what's 5.75 to 6, give or take?
It's hard to say because here's the reason why. If you talk to a loan officer,
Yeah,
every loan officer is going to say, "I can get you the lowest interest rate."
yeah, of course.
What they don't tell you though is you have to pay points in order to get that low interest rate. So
Right.
what you're doing is you're prepaying the interest up front on to get that rate. But then if you ever refinance and you look and you do the math of it long form, you're talking you got to keep that rate at about 12 years in order for it to make sense for you to have paid all that interest up front. Most people are probably going to refinance within the next 5 years.
Yeah.
And so, therefore, buying the interest rate down doesn't do any good. So, right now, today, the par rate, and when I say par rate, that means that you're not paying any points. The par rate on interest rates right now today was 7.125%.
Is that conventional only though, right? Or did that also
That,
include FHA and VA? Because I've
that
seen them
includes
lower.
all of them. So the conventional is a little bit higher, but FHA VA is going to be 7.125. Conventional is going to be dependent upon how much money you put down, what your credit is. There's a lot more factors into that. But the point that I want to make though is the Federal Reserve right now today says that their interest rate is between 5.25% and 5.5%. So what I want to do is I'm going to go on the low end for the Federal Reserve. They're at 5.25. So if we take off 0.75, that's going to take you down to 4.5%. Now on the high end,
That's the bank's rate now, everybody.
that's the
So,
bank rate.
yeah,
That's what the
so their
banks are
banks
going to
are
get doing.
paying. Yeah.
Now I'm going to go with the higher rate of 5.5% when I calculate what the margin is right now for banks. The margin right now for a bank, if they're borrowing it from the Federal Reserve, is 5.5%. And I'm using the high number, not the 5.25. They're basically borrowing the money and charging the consumer 1.625%.
Yeah.
So if the Federal Reserve goes down to 4.5% and they're charging 1.625% on top of that, you're somewhere right around 6.125% is where we will probably be after all the cuts are done. And that's the par rate.
Probably towards the end of 2024 then.
Probably towards the end of 2024. Again, it's the par rate. You'll always have loan officers saying, "Oh, I can get you a 5.75 because they know a 5 sounds prettier than a 6 on the front."
Right.
But you're going to have to buy that rate. Not advised.
Now, there's folks out there, screaming that, well, 2024, they hear there's going to be a looming recession. Um, I'm still, I'm still thinking, like you mentioned before, that we could be in for a reverse market crash if we go above what Powell is saying. I think he's smart about doing it very bearishly. Here's there's a
Yes.
0.75, but if it does indeed go much higher and we end up in the fives again, I think that's a magic target where we'll see the reverse market crash. And what a reverse market crash is, we have a complete surge in home prices again because of buyer demand, because there's a lot of pent up buyer demand because of interest rates, and people have been waiting on the sideline for those interest rates to go down to get in the right time to buy. So they would extend their lease where they were renting until they got it, uh, until they thought it was a great time to buy in.
Yeah, there's been people waiting since 2020. We talked about this a few episodes back.
Mhm.
People have been on the sidelines since 2020. And so there is a huge amount of pent-up demand for housing. The problem is there's a major shortage of housing in this
Yeah,
country.
that's not going to be solved anytime soon.
It's not going to be solved anytime soon. It's also the reason why I believe the Federal Reserve is going real bearish on dropping the rates. They're going to go very slow because it's going to take time and investment of government money into solving the housing crisis in America. And it really came from back in the 1970s. The government was spending $22.4 billion a year on government housing projects. After the housing market collapsed in 2008, in 2016, they dropped the amount of money they were investing down to 10.2% billion dollars. So it was a huge cut, a half. They cut the amount of money they were spending in government housing projects in half. And so therefore, the reason why was because the banks had all these foreclosed homes on their books. So they did it in order to get those houses off the bank's books. Now, they didn't ramp back up fast enough in getting that money back into HUD's hands so that way they can fund government housing projects. This year, they're at $17.2 billion that they're investing into government projects for 2023, but we're still not back up to where we need to be at. And therein lies part of the reason why we have this huge housing crisis.
Yeah, and the Fed chairman also said that he's not ruling out a potential recession. Matter of fact, he said he warned that the U.S. economy could still make an unexpected return into recession despite its resilience in 2023. There's little basis for thinking that the economy is in a recession now. I think there's always a probability that there will be a recession in the next year. It's a meaningful probability no matter what the economy is doing. So it's always a real possibility. The ability to bring inflation back down to 2% without causing a large spike in unemployment could qualify as a soft landing, but Powell isn't ready to call the process a success. He says the result is not guaranteed and is far too early to declare victory. I think that's what reason why he said that is he was just cautious about it. He's like, look, I don't if recession happen, he doesn't know if a recession is going to happen or not. That's why he's just playing it safe.
Yeah, he has to.
Yeah.
He has to be very safe because let's be honest, the market reacts anyway to every word that he said.
Right.
That's the type of power that he wields with his words. So when you hear people say that words have meanings and words have power, this is the type of power we've seen the stock market rally go to its highest all-time high.
Yeah.
So but I think the reason why he's remaining cautious, though, is because we cannot forget about the small business owners and those medium-sized companies out there that have been operating with large amounts of debt. We just don't know how much longer they can take these higher interest rates before things go sideways. And if those small businesses go bust, so does the labor market, so does the economy. That will be the thing that drives us into a recession.
Yeah, because these mom and pop businesses, as well as the medium-sized businesses, you got to think they're taking on, they have to take on loans to do their day-to-day business operations, right? So if they borrowed, you know, at the rate in 2020 and with a 3-year maturity and it's coming due, like say at the end of 2023, now they have to make that decision. Uh, do I reduce my operations, my supply, my staff, or do I reborrow at the current interest rate in 2024? But if you think what the interest rates are in 2020 versus 2024, I mean, you're talking about double, possibly triple. I don't know what they would have borrowed at, but
Well, the
that's
prime rate right now is right around 9%. So
okay.
if they
Yeah.
got really good credit, they could probably get it close to 9%. If they got so-so credit because they're starting to slide back on some of their loans, then they're probably going to be closer to 10, maybe even 11 percent on those interest rates.
So that makes sense. That's what we pay on that last one we did was like 13%, the last flip we did.
Yep.
So there was a prime rate of whatever it was plus yeah.
Yeah, but it's hard money. It's a little bit different than when businesses borrow money on their lines of credit in order to operate.
Mhm.
It's a little bit different than that whenever you use hard money to rehab houses. But something interesting that I seen today was I seen a Instagram reel or something that said that for the first 7 years of its existence, Facebook operated in a negative, meaning for the first 7 years, that company was negative. It wasn't until the eighth year that it actually became profitable. And it was 13 years before Amazon became profitable. So there are a lot of companies that are in those first 13 years of their existence that have been just piling on the debt. And now is that time when they either need to refinance that debt with the hopes of lower interest rates, but cuts from the Federal Reserve, or they may end up going out of business.
Yeah, we're already starting to see that already. I'm sure that you know, YouTube as well as other articles about big box retailers having issues right now, even supply problems, supply chain problems. And some of the big box retailers, you go to find the part you need or some supplies you need or something, and they don't have them in stock. Even though the website might say it does. I'm not going to say any names.
Oh, I mean, I don't mind throwing out a name. I mean, you and I, we were looking at an article today that talked about Redfin,
Oh yeah.
and it looks like they're in some serious trouble. And I mean, they're here in the real estate industry, and it doesn't look good. It's not a pretty sight when you look at the statistics for their company and how much cash they had on hand, and now how much debt they have on hand in comparison to how much cash they have on hand. So they did a complete 180, if you will. They were high in cash, low in debt, and now they're high in debt, low in cash. That's
But
not a good recipe.
I'm sure they're trying to turn things around. They have some sort of new feature where you can decorate the house you're looking at.
Yeah, that's just added expenses for home shoppers to be shopping on a website, which, by the way, I mean, I don't have the data in front of me, but I think that most of you all out there would say that if you were looking for a house, probably the number one place you'd go to is Zillow, like
Yeah.
most people. So, yeah, I'm not sure that you should be investing money into adding more features onto your website, especially meaningless information like decorating a home. That's meaningless. That
They
you
have
can,
apps for that.
yeah, you can go tour a house and figure that out in your, while you're touring the house. That's not something that a company should be investing its money into, because anytime you're investing money into something, you have to say, what is the return on investment in investing this money into whatever it is? If there's no return on investment, which decorating a house on Redfin's website is not going to give them return on investment. They don't even sell ads in that manner that would, benefit them. So it's not a good idea. It's a poor investment, in my opinion.
Well, if companies like Redfin need to take on more debt as well as other companies, uh, now Powell did say that we are prepared to tighten policy further. So he says, yeah, even though we're gonna, drop the interest rate a little bit, he said that while the Federal Reserve's policy rate is likely at or near its peak in the tightening cycle, he would not rule out another rate hike. We are prepared to tighten policy further if appropriate, he said at the post meeting press conference. In fact, the central bank is committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation down to the 2% target rate over time, he added. While participants do not view it likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table, he said. So he's again being cautious about what's about to happen because it's a big balancing act. Would not like to have this dude's job. Um, so going forward, he's like, well, it may not be a recession. We might hike rates if we need to, because it doesn't matter what's going on. He his primary focus is on labor market and bringing the inflationary rate down to 2%. So he's going to make adjustments accordingly. So people that are going to be buying houses out there and you're thinking about doing it in 2024, don't think the rates are going to continuously keep falling. He just said it. He might raise them again. So if you wait and wait and wait for this, magical time, it might not happen. They just might raise the rates again.
Yeah, there's
Yeah.
so
So
many reasons why you should not wait. If
no.
you are in need of buying a house, buy a house. Don't worry about the interest rates, buy a house. Worry about the interest rates when you're in it, and if it goes down, refinance. But to try to play this game
Yeah.
and say, I'm gonna buy at the perfect time, yeah, you might be waiting a very long time. And I think the reason why he made this comment about they reserve the right to increase the interest rates again if necessary is because if that reverse housing market
Crash
crash
happens. They have
happens,
to.
they're going to need to
They're going to
do
need
it.
to do that.
We've already just said that of all the new inflation that is calculated, 70% of it is in shelter.
Yeah.
So, and we've already outlined there's a lot of issues that have to be tackled, and there's no easy solution to this problem. And, I think you brought up an article the other day where I think they were talking about redeveloping some commercial property or something.
Yeah. I think that's a smart move because a lot of commercial space, it's just drastically lower. I hate to throw out a number, but I'm going to just go ahead and make a guess. Somewhere around 50% of unoccupied spaces in the commercial space. That, especially these big buildings, they can redevelop those in maybe apartments or condos of that or mixed use developments. Mixed use developments is where, they would have condos in there, but they would also have like a grocery store or something like that,
Restaurants.
restaurants or
Hmm.
something like that. So that, once you go home to your condo, you could stop and get some necessities and maybe like a 7-Eleven and some type of style there, and then go back up to your unit. That would actually be awesome,
Yeah.
especially in the cities and whatnot. But they're actually it might have to be something on the next podcast we talk about because I think the government is proposing ways to try to make that more attractive for developers or investors to go ahead and do that.
Yeah, they would need to. I mean, there's tools that they have, so they could do tax incentives
Yeah.
to builders and developers to go in and redevelop these commercial spaces that aren't being used anymore because businesses found out it's cheaper to leave some of their workers at home and not require them to come into the office. It's less office space that they have to lease out. The cost of rent is already at its highest as of the last inflationary reading. Rent accounted for 7.2% of inflation, which
Right.
it was the highest thing on the list with inflation on it. So for businesses, especially, we've already talked about it. A lot of them have a lot of debt on their balance sheet, and so if it comes down to
Like
having,
Redfin.
yeah, if it comes down to having a lot of people come into the office or leaving people to work at home, and a lot of workers feel more comfortable at home. You
Yeah.
just have to make sure that the productivity is the same as you would get in the office, so that way that you don't end up in a situation where you're not paying for a commercial building,
Mhm.
but people aren't doing work at home. So as long as you have good managers who are managing the workers, that's a viable way of cutting down some of the debt that these businesses have, and it could help to keep some of them afloat in these tough times until these rates go down.
Yeah. Well, I'll tell you what, who's going to be sitting pretty for the next year? Homeowners are trying to sell.
That is true.
They're going to be just fine.
Yes.
Yep.
But at the same time, though, you know, if they do have aspirations to move,
Mhm.
it's going to be difficult. It's going to be a challenge to move, even for somebody who's maybe downsizing, older family who's like, hey, let's just downsize and get a smaller home. It's going to be hard to leave a nice big house that you own at X price in order to go buy a smaller home
At the same price.
at the same price. So yeah, I mean, we're laughing, but it's not
No,
necessarily
it's
that funny. But it's just the you know
that's just another thing that's contributing to the inventory problem because I was reading the stat that over 40% of homeowners across the United States right now own their homes free and clear. They don't have a debt on it, but they're not selling their homes because, like you were just
yeah.
alluding to, you have empty nesters that have the big house, all the kids moved out, trying to downsize to a nice little ranch. And then they go look at the prices of that nice little ranch, be like, holy cow, I'm just going to stay put where I'm at, and just keep having a bigger house because I'm not trying to spend the same amount of money for that house as I did for my house, some number of years ago and have the same mortgage payment or something like that. So it almost doesn't make sense to do that, especially with the interest rates. It'll bring up the payment even higher probably when they bought it, especially if they bought within the last, I don't know, 10 years or so.
Yeah,
It
but
just
the bigger problem is this right here. So
so that'd be just less inventory.
yeah, there'll be less inventory, but here's the other problem, right? So I've seen this article somewhere, I don't know, remember, but they claim that next year, 2024, the largest market for selling homes is going to be the baby boomers, right?
Hmm.
But what I don't think the article takes into consideration is that baby boomers are on fixed incomes. Let's say that they have their current house that they own free and clear, and it is valued at $750,000.
Yeah.
If the cost for them to sell that house and go to a smaller house they want to downsize to, and it's going to cost them a $500,000 to get that house, well, now 2/3 of what they made off of selling their house is ate up in buying their new house. And they're on fixed incomes. So it really doesn't help them that much whenever the home prices are inflated because there's low inventory.
Well, a lot to unfold and to extrapolate as we just did. So before we wrap this up, what are your we're just speaking out loud here. What are your predictions for 2024?
I stay on the math that I gave you earlier.
Hmm.
I think that we stay on target at 0.75% basis points because there's too many other factors that have to be solved before interest rates can go any lower. With that being said, I put the Fed's rate at 4.5%.
Hmm.
and I put consumers rate at 6.125% based on the margins that the lenders are loaning money at right now, and where they're going to, give it to consumers in the future. And I think part of the reason why they have to keep their margins where they are is because they've already calculated the risk with credit card debt. And I don't think we touched on this today. We touched on a few other episodes ago, but credit card debt is at an all-time high.
Hmm.
And so a lot of these banks and lenders, they have to factor in the risk that there could be a huge downturn in people paying their credit card bills on time. And so therefore, they have to keep those margins because the margins on home loans helps to offset the risk with credit card debt.
So you're going to be a little bit more bearish. I'm going to go ahead and go with the speculators on Wall Street with the 150 basis points, and I'm gonna go ahead and say it's going to be a reverse market crash. We're going to hit, and not only that, it's going to be a feeding frenzy off of refinances for loan officers. Hopefully, they don't get sloppy, and hopefully that everybody stays within good standards and keeps those tight lending standards in play, and keeps the market healthy. But I'm thinking we're going to be in the fives. I think we're going to hit 5.75, 5.9, and we're going to and demand's going to surge, and home prices are going to soar, and there's a lot of people going to get priced out of the market, unfortunately, and sellers are going to rally.
I mean, I can see a lot of what you said being true. We're not that far apart, even though it may sound like it.
Yeah,
We're a few basis points apart.
yeah.
But I you brought up a really good topic about the refinancing. So I think that we should get a guest on, maybe one of our loan officers, and talk about the refinance process. And if rates do go down, what does that process entail? Because there are a lot of people who say, "Hey, buy now, refinance later," but a lot of people don't know what the refinance process is. So it's kind of the fear of the unknown. You're telling somebody to do something with a secondary thing that they're going to have to do that they don't know about. So maybe it's a topic for the future.
Yeah, we'll have another guest on since we have the setup now. You guys probably noticed we have some new features right here on the podcast. If you're watching the video podcast here, oh, by the way, as we wrap this up, guys, if you haven't already, please hit that subscribe button. And thank you to all the people that have already subscribed to our channel. We did not believe that we would have gotten this far in such a short amount of time with subscribers and view count. We really appreciate that. And also, if you guys are feeling generous, please hit that super thanks button and drop us a tip if you like. Every dollar that we're going to receive is going to go back into the podcast so that we can add more things to it to make it better than we already have. And yeah, go ahead and like the video if you like it. Leave a comment below. Let us know what you want to hear us talk about in the future. We'd like to include you guys, our audience, in on our future discussions. So that's it. Thanks for watching. See you soon.